Stop scrolling, because the silver market just pulled one of the most violent rug pulls you'll see in a normal commodity. Silver hit a fresh all-time high, and then dropped about $15 in roughly 4 hours. Not over days, not over weeks, 4 hours. If you're staring at the chart thinking, did I just watch history? Or did I just watch a kill switch get flipped? You're asking the right question. Welcome to my channel. No fluff, no bedtime stories, just the mechanics behind the move. Now listen closely. This was not a calm correction. This was not healthy profit taking. This was not a neat little pullback from resistance that a TV analyst drew with a marker. This was a mechanical event, a forced event, a pressure valve releasing, right as silver was becoming too expensive for certain players to tolerate. And the worst part? Most people will leave this story thinking silver crashed because it was overbought. That's not what happened. Here's what happened. Silver screamed to a record, traders piled into leveraged exposure, shorts started sweating, and the rules of the game changed while the game was live. That's the core of this video. And before we go further, quick CTA. If you want breakdowns like this when the market gets weird, hit subscribe. Short and simple. Subscribe so you don't miss the next one. Because this wasn't just a red candle, this was a message. And I want you to answer this in the comments. Do you think this move was market forces or a controlled reset? Just pick one. Market forces or controlled reset. Okay, let's reconstruct the sequence. Silver pushes to a historic print, euphoria everywhere. The "this time is different" crowd is loud, the momentum crowd is louder, and the leverage crowd is the loudest. Then the floor drops out. Fast, hard, no gradual rollover, no gentle drift lower. It was a stair-step down, like someone unplugged the rally. If you were holding futures, levered CFDs, or anything that depends on margin, this wasn't pain. This was liquidation. And liquidation always feels mysterious to people who don't understand how futures markets actually work. So let's keep it plain, fast, and brutal. In silver futures, you don't pay the full cost of the metal. You post a deposit, margin, and that deposit lets you control a massive position. That's the whole reason futures exist. Leverage, speed, liquidity. But leverage has a leash, and the exchange holds the leash. If the exchange raises margin requirements, they effectively raise the price of staying in the trade. Not the spot price, the permission to remain long. And that difference matters more than most people realize. Because if margins jump suddenly, a huge slice of traders don't get a choice. They either send more cash immediately, or they get forced out. Not because they changed their mind, because they ran out of runway. That's why margin changes can drop a market like a guillotine. And that's why the timing of margin changes is never just administrative. When silver is calm, margin changes are boring. When silver is vertical, a margin hike is a hammer. So ask yourself, if silver is ripping, shorts are trapped, and the market is getting crowded on the long side, what's the cleanest way to break the crowd without shorting it down in public? You raise the cost of holding the crowd. Then you let forced selling do the dirty work. That's the kill switch. And once forced selling starts, the chart stops being a debate and starts being physics. Stops trigger more stops. Liquidations trigger more liquidations. Market orders hit a thin book, and the drop feeds itself. This is why 4 hours can erase days of upside. Now here's the part most people miss. When a crash is driven by forced selling, it doesn't mean the underlying story changed. It means positioning changed. It means the paper structure got snapped. It means the market got cleaned. So if you're trying to understand why by looking for a headline, some sudden demand collapse, some miracle supply discovery, you're looking in the wrong direction. The why is in the plumbing, and the plumbing is margin. Now I'm going to make this uncomfortable, but you need to hear it. The exchange claims margins are about risk management. And yes, sometimes they are. But margins can also be used as a steering wheel, because they impact who can stay in the trade. They decide whether the leveraged crowd survives, and the leveraged crowd is often the fuel of a breakout. So when you raise margins into a frenzy, you're not reducing volatility, you're detonating leverage. And leverage is what makes price move fast in the first place. This is why these events look like attacks, because functionally, that's what they are. A legal, procedural way to force a one-way stampede. And if you've studied silver history, you've seen this movie before. Silver starts running. The market gets crowded. Then, suddenly, conditions change. and price collapses in a way that looks too sharp to be organic. People call it conspiracy. Others call it coincidence. I call it incentives. Because here's the uncomfortable incentive. If major players are structurally short, a runaway silver price is not just annoying, it's existential. A high silver price isn't a number, it's a bill. And every dollar higher is a bigger bill. Now let's layer in what makes silver uniquely explosive. Silver is not just a precious metal, it's also industrial. So demand isn't just jewelry and coins. It's solar panels, electronics, electrification, high-performance components. The modern world is wired with silver. That creates a weird tension, because paper can be created instantly, but physical supply cannot. Physical silver has to be mined, refined, and delivered. That takes time, energy, and capacity. So when the paper market experiences a forced reset, the physical world doesn't magically reset with it. And that's where the most important story lives, the divergence. Because while paper is doing gymnastics on a screen, real buyers still have to source metal. They still have to pay the premium. They still have to deal with shortages, shipping delays, and out-of-stock banners. So here's the key concept you need to lock in. The paper price can crash, but physical tightness can remain. And when those two separate, you get what I call the divorce. A widening gap between what the screen says and what the street pays. That gap is not a trivia point. That gap is the stress fracture in the entire pricing system. Because if physical buyers are paying far above the official price starts looking like a reference number, not reality. And once enough participants treat it like a reference, not reality, the control weakens. Now, I'm not telling you the system is dead today. I'm telling you that every forced reset accelerates the erosion of trust. Because every time the market sees a vertical rally get chopped by a mechanical rule shift, people learn a lesson. Paper exposure is not the same as metal exposure. And that lesson spreads. Now, let's talk about the human casualties because this is where it gets real. When leverage gets detonated, it doesn't just hurt traders, it breaks businesses. It wipes out firms that were positioned correctly on fundamentals but incorrectly on structure. This is one of the cruelest parts of commodities. You can be right about the big picture and still get destroyed by margin mechanics. And when forced selling hits, it doesn't discriminate. It doesn't care if you're smart. It doesn't care if you're early. It cares whether you can post cash today. Not tomorrow, today. This is why some players go from confident to gone in a single session. Not because they lost the argument, because they lost liquidity. So if you were watching this collapse and thinking, how can a market do this? That's your answer. Leverage plus a margin shock equals forced liquidation. Now zoom out and ask the bigger question. If the physical market is tight, if industrial demand is real, if the world is building more electrification, more solar, more high-tech hardware, how sustainable is it for paper to keep overriding physical signals? That's the endgame question. Because paper can control the quote, until delivery stress forces a reckoning. The paper system works as long as people accept cash equivalents, as long as they believe paper claims are as good as metal. But when enough players want the metal, when they demand delivery, or when they simply refuse to accept paper promises, the system has to either deliver or change the terms. And that's where things get spicy. Because the moment an exchange can't comfortably deliver, you start hearing new language. You start hearing alternative settlement. You start hearing cash settlement. You start hearing emergency measures. And every one of those phrases is the market admitting, metal is harder to produce than paperwork. Now I'm going to give you 3 realistic paths forward from here, because you need a map. Path 1, the reset higher. In this path, the market digests the margin shock, the weak hands get flushed, and price eventually pushes back up, because the underlying demand and tightness reassert themselves. This is the shakeout then continuation path. It's the path that destroys late leverage, then rewards the patient. But it requires one thing. The rally has to return even after the crowd gets burned. And the crowd only comes back if they believe the breakout wasn't fake. Path 2, the permanent divorce. In this path, paper and physical stop converging. Paper keeps swinging wildly on leverage and rules. Physical trades at its own premium-based reality. 2 prices, 2 worlds. And if you're wondering whether that can happen, look around at any market where shortages exist. When supply is constrained, premiums become the real story. And the spot price becomes a starting point, not the final cost. Path 3. The forced settlement moment. This is the one nobody wants to talk about on mainstream TV because it destroys the illusion of perfect liquidity. In this path, physical demand intensifies, inventories draw down, and at some point, the system has to protect itself. Not with a margin hike, with settlement terms. If the market cannot or will not deliver enough metal, it will offer cash instead. And when that happens, the paper price loses its authority instantly, because the whole point of a commodity contract is the option of delivery. If delivery becomes optional in practice, then the price becomes a managed number, and managed numbers eventually get ignored. Now here's the cliffhanger, because you need to be thinking one step ahead. Everyone is focused on the drop. But the bigger question is, what happens after the flush? Because flushes do two things. They reset leverage, and they transfer metal, or exposure, from weak hands to strong hands. So ask yourself, who benefits from a mechanical crash? The over-leveraged crowd gets destroyed, the patient buyers get a discount, and the shorts get breathing room. But breathing room isn't victory, it's time. And time matters because industrial consumption doesn't pause for margin requirements. Factories don't stop needing metal because the chart went red. Supply chains don't relax because futures traders got wiped. So if the physical tightness is real, a paper crash doesn't solve it. It just delays the recognition. That's why these events often feel like desperation. They're buying time against a constraint that time doesn't fix quickly. Now I want to talk directly to two types of viewers, because one of you is in danger. Viewer type 1, the leveraged paper trader. If you are trading anything on margin, your number one enemy is not the market direction. It's the rules. You can be right and still get liquidated. So if you insist on leverage, you must respect the possibility of sudden margin changes and sudden liquidity vacuums. That means smaller size than you think you can handle. That means planning for margin jumps. That means understanding that the exchange can move the goalposts when volatility spikes. Because if you ignore that reality, you're not trading silver, you're trading survival. Viewer type 2, the physical holder or the long-term buyer. If your thesis is about scarcity, industrial demand, monetary distrust, and long-term repricing, then a paper flush is not a thesis breaker. It's a stress test. The question isn't, did silver drop? The question is, did the physical situation loosen? Did premiums collapse? Did availability suddenly improve? Did inventories surge? Did lease conditions normalize? If those answers are no, then the crash is more about paper mechanics than reality. And that's the key. You don't judge a structural story by a 4-hour liquidation event. You judge it by whether the underlying constraints changed. Now here's where I'm going to challenge you. Write this in the comments. If you could only choose one, would you rather hold paper exposure at a lower price or physical at a higher premium? I want to see where people actually stand when things get violent, because this is how markets train you. They train you to believe the screen is the truth, and then they remind you the screen is a game board, one that can be tilted by rule changes. Now let's tie the whole move together in one clean line. Silver didn't lose value in 4 hours. The paper structure lost stability. That's what you watched. A leverage fire, a margin shock, a forced unwind. And it's brutal, but it's also revealing, because it exposes who has control over the short-term quote. And it exposes how fragile price discovery becomes when a market is dominated by paper leverage instead of physical exchange. So what should you do next? First, don't let panic write your decisions. If you're long-term and unlevered, panic is expensive. If you're leveraged and unprepared, panic is inevitable. Second, watch the real signals. Not the influencer noise, not the victory laps, not the doom threads. Watch the physical market indicators, premiums, availability, withdrawals, delivery stress, and any signs of real-world tightness. Third, respect that this can happen again. If silver tries to run again, the same tool can be deployed again. That's not pessimism, that's pattern recognition. And pattern recognition is how you stop being emotionally robbed by volatility. Now let me end with the blunt truth. Today wasn't just a crash, it was a reminder. A reminder that the silver market is not a gentle place. A reminder that leverage is fragile. A reminder that rule changes can turn confidence into liquidation. And a reminder that when silver gets too loud, someone always tries to turn down the volume. But here's the part they can't manipulate forever. They can smash paper. They can trigger stops. They can raise margins. They can terrorize the chart. They cannot print metal. They cannot speedrun mining. They cannot conjure refined supply with a policy memo. And that's why the story isn't over. Not even close. If this was the kill switch, it means the breakout was scaring someone. And if the breakout was scaring someone, it means the pressure is real. So stay sharp. Keep your eyes on the plumbing. And don't confuse a 4-hour forced unwind with the end of the silver story. Subscribe to my channel if you want the next breakdown the moment the next move hits. Because if you think this was the last ambush, you haven't been watching this market long enough.